If you think that having a high tax bill means that you're rich, well, think again. Look, I know you want to pay as little tax as legally possible, right? Who doesn't? But the more money you make, the higher taxes you have to pay, right? Well, maybe not. That's what we're going to break down in today's video, the tax loopholes that the rich like to keep all to themselves. If you're new to this channel, I'm Dr. Jeff Anzalone, a Louisiana periodontist on a mission to spread passive income education to those of you so you can get out of the rat race. If you haven't already, you can download the free passive income guide with the link below this video. Question: why did the ultra wealthy like Bezos and Buffett pay so little in taxes as compared to the income? It's because they know how to play the game, the tax game. Even if you're an attorney or you're a doctor in the highest income tax bracket, there's always multiple ways that you can use tax reduction strategies to pay the IRS as legally little as possible. But you have to make it a point to either stay on top of the ever-changing tax laws or surround yourself with advisors that can do it for you. I prefer the latter. So how can you take advantage of all these new tax laws and figure out what strategies still exist for the high income earner? You first have to understand the basics, the tax basics, and educate yourself. As with anything in life, education is the key. For instance, I got tired of hearing all about all the different ways you can make money with cryptocurrency. People were telling me to mine it. People were telling me to store it. People were telling me to stake it and all the different coins that I should buy. Now, I realized that I had no business investing in anything that I didn't understand. So, what did I do? I decided to do something about it. So, I spent hundreds, yes, hundreds of hours self educating myself on books, podcasts, watching YouTube videos, and actually interviewing experts within the crypto space. It wasn't until I had like a basic understanding of how it all works, plus the risk and the benefits, that I could then put together my own personal crypto strategy. But if I wouldn't have done that and just blindly plowed ahead doing what everybody else was telling me to do, I would have lost a lot of money. So again, first start with education. And regarding taxes, it's really important that you understand how taxes work in the first place. So let's start off with the federal income tax bracket. Your federal income tax bracket is basically the percentage of tax that you owe the IRS on each tier of taxable income. So once you know your taxable income, you can actually use the chart that the IRS will provide you to determine your federal tax bracket. Now, here's one of the big secrets the rich always utilize. You ready? They always know how the next dollar of their earned income or their active income, for me as a periodontist, how the next dollar of the active income when I'm treating patients will be taxed. Okay, let me repeat that. They always know how the next dollar of earned income will be taxed. So, for instance, if you take the 2022 income tax bracket, and let's say somebody's making $300,000 a year, well, that means that they're going to fall into the 24% tax bracket. That does not mean the entire $300,000 tax. It's taxed in different tiers. So basically, the first $20,500 you pay no income tax. From 20,500 to 83,550, only the amount that falls in there is taxed at 12%, and so on and so forth till once you reach the 300,000. So only from 178,150 to 300,000 will be taxed at this 24% rate. So that again, they always will know how the next dollar of earned income will be taxed. So in this situation, this person would know if they bump up into the new tax bracket, then this range right here, 340,100, 431,900, that will be taxed to the 32% bracket. And vice versa. Like if let's say you're just right on the border here, well, what could you do to get to the point where you could reduce that to here? So again, knowing these brackets is one of the keys to starting off with taxes and tax education. Now let's talk a little bit about the standard deduction. So for 2022, for married couples filing jointly, it actually goes up $800 a year to $25,900 from the prior year. For single taxpayers and married individuals filing Separately, the standard deduction actually goes up $400 to $12,950. Non-business owners, employees, will continue to have a difficult time coming up with expenses to write off that's going to be higher than the standard deduction. It's for this reason that high income earners are always looking for new business opportunities. Remember that business owners, on Robert Kiyosaki's cash flow quadrant, that the business owners and investors, which he calls the rich side, they're on the right side. So these business owners and investors, they're the ones not using the standard deduction, and they pay the least tax. And then versus on the left side, the employee and the self-employed. So remember, if you're an employee, that means you basically have a job, you have security, yet you're going to pay a lot of taxes because you don't have any write-offs. Okay. If you're self-employed like me, you're also going to pay a lot of taxes because with as an employee, you get to split some of the different taxes with the employer. As a self-employed person, I'm also the employer, so I don't get to split it with anybody. I've got to pay the full amount of self-employed taxes. So this is considered, the left side is considered the poor side. So the self-employed person like myself, we we own a job, but yet in essence, if we aren't there, we get no money. So actually, being in this quadrant, the job owns you, so the job owns me. So the goal is to get from the left side to the right side. The big business owner, they own a system and have people working for them, so they don't have to be there. And then the people in the investor quadrant is is ultimately where I want to get myself, plus where I want you to get, and that is where you can sit back, relax, because in this quadrant, money is working for you. You are not working for money. I had a call last week or maybe a week and a half ago with a sort of new dentist in Seattle. And he told me, getting to the end of the year, he said, look, my accountant just told me, I made a lot of money this year, but my accountant just told me that what we were originally forecast, I'm actually going to have to pay an extra $80,000 to the IRS. And he just kind of took it on the chin, like, I guess that's just how it's got to be. But again, it all comes down to education. That particular individual is better off not working anymore, trying to make more money and just paying more taxes, but actually he's better off educating himself and hiring advisors to help him with some of these tax reduction strategies we're going to talk about. Next, let's get into the capital gains tax rates, specifically the long-term capital gains tax rates. Typically, long-term capital gains are taxed using different brackets than your ordinary income. So it's important for you, especially if you're going to start making passive income, to know what those rates are. So for instance, if you're either going to pay 0, 15, or 20%, whereas when you're over here in the ordinary rates, it actually goes up to, I didn't put it in, but it actually goes up at this point to 37%. So if you're making anywhere from up to, I think, about $80,000 or less, you're going to pay 0% in capital gains taxes. So a lot of the passive income, if your income is about $80,000 or less, you're not paying any tax on it. If you're probably, most of you are between the $80,000 to about $500,000 range, you're going to be paying about 15% taxes. And then anything over 500, I think it's like 501, 600, something like that or more, you're going to be paying 20% capital gains taxes. So now let's get into some specific ways that you, the high income earner, can save on your tax bill. Now, the first one is what we're all very familiar with, and it's with retirement accounts. And one of the easiest ways to begin to decrease your annual income tax bill is by contributing to a retirement account. Investing in these, like a 401k, 403b, helps in that every dollar you put into it each year is not taxed until what? Till you take it out. These contributions actually allow you to reduce your annual tax burden. The reasoning behind this strategy is that if you wait until you've retired to actually withdraw your money, then at that point, supposedly your income will be lower because you're not going to be working and receiving a salary. This results in putting you in a lower tax bracket. So the money that you withdraw will be taxed at a much lower rate than it would have been if you'd had to pay taxes on it when you earned it. All right. Now, moving on to my favorite tax reduction strategy, is real estate. And the main reason that I like this is that you're able to recover the cost of this income producing property through the use of something called depreciation. Now, the IRS allows owners of resident occupied real estate to depreciate property over 27 and a half years. An example of this would be if you were to purchase an apartment complex for 3.5 million with a net operating income, that's what it makes a year, of 200,000 a year. Now, in this situation, and all situations, the IRS does not let you depreciate land. So in this example, our land is going to be valued at $750,000. So what we do is we subtract out the land cost from the 3.5 million. That gives us 2.75 million. Because the IRS allows you to depreciate over 27 and a half years, you take the 2.75 million, you divide it by the 27.5, that gives you $100,000. So in this example, the IRS allows you to depreciate $100,000 a year over the next 27.5 years as a paper loss. Remember, the net operating income was $200,000. That was your income, but you're not going to have to pay taxes on that because you're allowed the depreciation. So you're only going to have to pay taxes on the $100,000. So what this means is tax with depreciation, you're only taxed on the 100,000. So if you're in the top tax bracket, let's say you're in the 37% tax bracket, 37% of $100,000 is $37,000. So that would be your tax that you would pay on this building, even though the net operating income is $200,000. The depreciation actually represents a paper loss that can be taken against the actual gain from the cash flow of the property, which typically the group that you'll be investing with or your accountant will be able to provide you with a K1. If you have K1 passive gains from, let's say, other business activity, then you can actually use those to offset gains, which again is going to save you in taxes in other areas of your portfolio. The next thing regarding depreciation and real estate is something called accelerated depreciation. And this is done usually by what's called a cost segregation study. This is where the IRS will allow you to front load the depreciation. So instead of taking the standard 27 and a half years, you hire usually an engineering firm or your accountant. They can get it basically set up for you. They'll come in, they'll do a study, again called a cost segregation study, and which basically they segregate out the cost. So instead of taking the property, so you've got this, let's say you've got this $3.5 million apartment complex. So instead of taking the property and dividing it out into two components, just the building and the land, they now let you divide it out into four components. So not only the building and the land, but also personal property and land improvements. Now, personal property, they'll let you depreciate that over 5 or 7 years instead of the 27 and a half years. What is that? Well, personal property is any of the non-permanently affixed items that you have on the building, such as carpets, cabinets, drapes, etc. Again, they'll let you depreciate that 5 or 7 years. Next, land improvements. They will actually let you depreciate that over 15 years, so accelerate that to 15 years. Land improvements like parking lots, curbs, swimming pools, sidewalks, etc. So again, instead of waiting 27 and a half years, this depreciation can be taken even faster. And then there's something that we're not going to get into today, but I think you should be aware of is bonus depreciation, which will let you take the depreciation even quicker than the 5 or 7 or 15 years. Another way that real estate can really help decrease taxes is something called a 1031 exchange. This is defined under the section 1031 of the IRS code and is one of the probably most popular quoted tax benefits of real estate investing. Now, this allows an investor to defer paying capital gains taxes on investment property when it's sold, as long as another like kind property is purchased with the profit gained by the sale of the first property. So there's two different timelines. So you have the first one is you have 45 days after you sell a property. So let's say you sell this building. Well, you've got 45 days after you sell that building to identify up to 3 new properties. That's the first timeline. Second timeline is you have 180 days to close on one of the 3 properties that you originally identified. Now, the property that's going to be replacing the original property must be of equal or greater value than before. Basically, this strategy allows you a way to defer taxes by exchanging one property and replace it with another like kind property. Again, you're able to take all of the proceeds from the sale of one property, buy another one with it, and the taxes on the transaction are deferred and kicked down the road. Pretty cool. All right, the third tax saving strategy is something called an HSA or health savings account, which you're probably familiar with. And it's the only account that offers what's called a triple tax advantage. What this means is that your contributions into this account are tax deductible. That's the first. The second, contributions grow tax free. And the third is when you take money out, those withdrawals are also tax free. HSAs are only available if you're enrolled in a high deductible health plan. And other ways that you can benefit by using these accounts is you can deduct your annual HSA's contributions from your income taxes each year. Plus, when you reach age 65, you can take out money from this account for any reason without penalty. Now, if the money was used for a non-medical expense, you only have to pay regular income tax on the withdrawals. Fourth way is to set up what's called a donor advised fund or a DAF. Now, this is a charitable fund that you can set up. It's going to allow you to decide how and when to allocate funds to charities. Using a DAF is probably one of the best tax strategies for high income earners. Why? Well, because it allows you to take current and future year contributions and deduct them all in the same year. So, for instance, you can go to a site like Vanguard or wherever, and you can open up one of these accounts and you make a contribution. If you itemize, that contribution can be a tax deduction on this year's taxes. Then that money will stay in that DAF account, invested in whatever you want for as long as you like. And the only thing that you do is you pay a custodian fee each year, which I think is like 0.6% at Vanguard. And then you advise the fund manager to donate money to your favorite charities whenever you feel like doing so. This is a great strategy to implement, especially if you have a year with higher than normal income. Maybe if you've inherited money or had a windfall or something like that, it's a good way to use charitable deductions to your advantage. So after you sign up with a custodian, like again, Fidelity or Vanguard, any money put into these accounts becomes a charitable tax deduction. This doesn't mean that the money automatically goes to a charity. You're the trustee of the account and you get to decide which charities receive whatever amount you want in that year and in future years. Let me give you an example. So let's say that you're planning on donating $20,000 a year to a local charity over the next 10 years. So this would be 20,000 times 10 years, $200,000, right? So let's say this year you had just a awesome year at work. Your practice did great, your business did great, whatever. And you realize that this extra income is actually going to, again, you remember the wealthy people, they know how the next dollar is taxed. Well, let's say you're sitting right here and then you know that, hey, if you make more than this, you're going to jump up into the 37% tax bracket. So then this might be the year, if you've had all this windfall, then this might be the year to get that tax deduction. So if you fund the DAF you knew that you were going to do $200,000, right? So if you put $200,000 into this fund, then you'll be able to get the full tax deduction up front while you're still in this highest tax bracket. And another hack with this would be using this fund. It's even more effective and instead of just donating cash, you can consider using any appreciated stock, maybe that's held outside of your retirement accounts. So whatever the stock is worth on the date of the donation into the fund, it's now tax deductible. So by doing this, you can avoid paying any taxes on the gain on the sale, making it a double benefit. So again, if you're a high income earner wanting to save on taxes, I urge you, please don't try to do this on your own. Wealth management can be very complicated. It's for this reason that it's very imperative to find a reputable CPA, somebody that can assist you with these different types of tax reduction strategies to make sure that your money is working hard for you as efficiently as possible. Speaking of getting your money to work for you instead of the other way around, I want you to check out this next video right over here where you'll start learning the secrets for growing multiple passive streams of income. I'll see you over here.